Hi everybody, Lance from tastytrade.com here, making this video on Father's Day. So happy Father's Day to all the father traders out there on 2023. Got this cool shirt. Says Super Daddio. Got my two daughters there. Going to be trying to get all the stars on Super Mario Odyssey. It's been pretty fun trying to get 999 stars. Anyway, in this video, we're going to go over the 112 strategy and different ways to possibly change your strike prices. We're going to look at what happens if you change your put debit spread strikes. And also going to look at where you change your two short put strikes and then notice the differences between them. And in this video, you should be able to get a better idea on where you might want to put your debit spread and put your short puts. If you want a little bit more profit and a less likelihood of success, you could do it that way. If you want a smaller chance of profit but a higher probability of success, you can do it that way as well. And you also could get different probabilities of the max profits as well. So let's just get right to it. In this video, you're going to look at different ways to structure the 112 trade. I do these trades every other Friday at tastytraders.com. If you're interested in looking at exactly how I set up my strike prices when I take profits, doing this on MES right now, and I have about a $32,000 account, so you can see how well profitable this strategy can be. So first, really straightforward, simple definition, because we're going to be changing these variables a bit. What is the 112 trade? Essentially, you're going to be buying a put debit spread, and it's going to obviously cost some money because it costs a little bit of a debit. But then you're going to sell two naked puts, and ideally it's going to be a little bit more than the debit, or it could be quite a bit more than the debit, as you'll see. And that's essentially it. If you're selling your two naked puts for a little bit more than the debit costs, it will be a net credit on the account when you start to trade. Also, if it ends at pretty much the same strike price that you're starting with, you would be receiving that same net credit that you started with. However, with the 112 trade, there's chances for even bigger profits than what you're starting with. So there are many different ways you could structure your strike prices. You could buy a debit spread for more money. In this case, you're going to be closer to in the money when you start to trade, and then more likely to get your profits. It does cost more, obviously, if you're spending more for the debit spread. Now, the debit spread could also cost less. In this case, you'll be further from the in the money, and that means you'll be a little bit less likely to hit those strike prices and get the profit from the debit spread. However, it does obviously cost less money. Okay, here's our first example. We're going to go 124 days out and sell two naked puts at 0.05 delta. And we're going to do a put debit spread. We're going to buy a put at the 0.38 delta, relatively high. That's pretty close to in the money, as you'll see. So MES is at 44.99. You could buy a 4400 put. That's the 0.38 delta. Sell the 4350 put. So I made it a 50 width spread. You also fit around the different widths as well. But for this video, we're just going to look at different deltas on the bought put here. It's about a 13 debit in this case. Then you can also sell two 3500 puts. That's a 0.05 delta. That's about 15 credit. Total credit's about 17. It's 15 times two of them is 30. Minus the 13 debit is 17. Your tail profit, if it stays where it is or goes up or even down a little bit, would be 17 times the 5 multiplier for MES. That's an $85 profit in the tail. Now, if you go between the 3,500 short puts and the 4,350 sold put and the put debit spread, you would make your debit spread profit as well and get $335. This is what it looks like on Thinkorswim. See, it's tail profit here of $85. This is if MES stays where it is, goes up, or goes down slightly. Make a $335 profit. And notice that this line is a pretty wide profit margin because we're selling a 0.05 delta and we're buying the put debit spread pretty close to that in the money. However, notice that $85 is your tail profit. What if we change the put debit spread to a much lower delta. So we're going to go down to a 0.15 delta here. You'll end up buying the 4050 put, selling the 4000 put, and the debit will be less because it's further away from the current price, or about a 6 debit. Then if you sell two 3500 puts, still getting your 15 or so. Total profit will be 15 times 2 minus the 6, or 24 is your initial credit. Your tail profit will be the 24 times the 5 MES multiplier, or $120. And then the profit between 3500 and 4000, notice the profit is a little bit less wide as the earlier one because our put debit spread is closer to it. Your max profit will be $370. So you look at the chart here, you do have a larger tail profit, $120, but we have a smaller max profit zone here because we're buying the put debit spread over here, further away from the in the monies. And the money currently is around here. So you would get a little bit more in your tail profit. You get slightly more in your max profit because your debit costs less than the first example, but it's a smaller zone of it. So here's the main takeaways. The more you pay for your debit spread, the greater the chance of your max profit, but it'll be a lower tail profit. Now, the less you pay for the debit spread, the lower your chance of getting that max profit. It's a smaller zone, like you just saw, but it's a greater tail profit. Now, you could also change where you sell your naked puts. If we sell a naked put at a higher delta, a little bit closer to in the money, then you'll be more likely to get assigned because you're closer in the money. However, it does bring in more credit. If you sell them at a lower delta, you're going to be further from in the money and also less likely to get assigned that way because you're further away, but it brings in less credit from the short puts. This example, we're going to keep the put debit spreads the same, around 0.26 delta. I'm going to sell two naked puts at the 0.05 delta. So we're going to be buying the 4250, selling the 4200. It's about a 10 debit. Sell two of the 3500 puts for about 15. 15 times 2 is 30, minus the 10 debit. Your total initial credit will be 20. Sale profits 20 times the 5 MES multiplier is $100. Now the profit zone is between 3500, where you sold your short puts, and the 4250. It's actually 4200 here, where you sold your put debit spread, and you would make $350. So here, getting a good credit here, a $100 credit, and then 350 is your max profit right here. Notice how the odds of it getting below that 0.05 delta put is really low, about 1.1%. It's lower than the 0.05 delta because you're getting this profit on the debit spread as well. And what happens if we change our short put a little bit this way and a little bit closer to in the money? Let's say we sell a 0.08 delta, same put debit spread. We're going to buy the 4250, sell the 4200 for about 10 debit. And then we get to move the puts up to about 3750 instead of 3500. This gives us more credit of 23. Total credit will be 23 times 2, 46, minus the 10 debit, or 36. Tail profit is a 36 times the 5 MES multiplier, around $180 in your tail profit. And you would profit between that 3750 and the 4200 here, which would be a $430 total max profit. Notice here, it's a bigger profit here in the tail because we're selling two naked puts with a higher initial premium. You do have the bigger max profit of $430 as well. Notice the percentage is going a little bit up to 2.3% because the short puts are a little bit closer to in the money. The takeaways on the short puts: the lower your delta, the greater your probability of profit, but you have a lower tail. The higher the delta, the lower your probability of profit, but you have a higher tail profit because we're taking in more premium initially. So as you can see in these examples, you can change your put debit spread, and you can also change your short puts It's very good to experiment in different situations. And you do this on Thinkorswim. You can even do it on paper trading if you want. When you're ready, you can actually do them with actual funds. And again, if you want bigger hedges or more likely hedges to actually hit, you could buy a little bit more and pay a little bit more of a debit for those. If you also want more of that initial credit, you can go a little bit higher delta. At Beta Traders, we look somewhere around the middle of all of this. We look near the 0.25 or so delta on the put debit spread, and I look around 0.07, 0.08 delta on the short puts. For me, that makes a pretty reasonable risk return profile, makes it a good initial tail profit that I'm happy with. There's a decent chance of that max profit as well, and I don't mind around a 0.07, 0.08 delta on the naked puts. Again, this is Lance with tastytrade.com. If you found this video helpful, please click like, subscribe, share it with others. It does help out the channel. Happy Father's Day if you're watching it on Father's Day, or if you're watching it after, still happy Father's Day and happy trading.